This is a Momentum Media production.
The SMSF Adviser Show. Your expert insights into the biggest themes shaping the SMSF advice industry.
Hello and welcome to the SMSF Adviser Show. I'm your host, Keith Ford, joined as always by my co-host, Aaron Dunn from Smarter SMSF. Hello, Aaron.
Keith, how are you?
Doing well, thank you. Yourself?
Yeah, all good. So back in the office again now. So getting cracking on a bit of work that needs to be done, and then it's going to come around very quickly, the SMSF Technical Strategy Days. So starting to turn my attention to that as well.
Of course. So a brief respite from the jet setting.
Yes, very much so.
Well, we've got lots and lots to talk about. We've got quite a bit of news that's come through this week, some interesting stuff. The first of which that we're going to talk about is a piece that we had on SMSF Adviser about removing an adversarial member from an SMSF and some of the difficulties that might pop up, some of the ways that the law has systems in place to deal with some versus others. So like a marriage breakdown, there are pretty well-worn legal paths that deal with this, but some of the other breakdowns that might occur are a bit less clear. So what do we need to know about this?
Well, it's not uncommon that we see self-managed super funds that might be set up with siblings, maybe set up with business partners, and various other ways where the law doesn't really provide any mechanism for them to unpack and depart in the event of dispute. As you rightly said, there is mechanisms within the Superannuation Law and Family Law Act and stuff that would deal with marital breakdown, but it can become quite tricky. Is probably using a very polite term there in terms of when a dispute arises and one party is accusing another and that party is accusing the other person, and they're in a fairly expensive battle to try and resolve a pathway out. And ultimately, the article here from William is talking about the fact that, the regs would require someone to provide that consent to be able to leave. And you can't just kind of go, you're booted out, or there can't be a requirement. Just go, well, I want to leave and absolve all my responsibilities, because what we have to always remember with an SMSF is when you come into the fund, for the large part, you are equally a member and a trustee or director. So you have responsibilities that you need to adhere to as well. And I guess there are times where you might want to put in place some type of conditional based membership and I know with the more family oriented funds, you can put in place a condition that would, in essence, the person that's coming in would accept and acknowledge that they will do the right thing or they will no longer be there. But by and large, that doesn't exist. And therefore, navigating a pathway out becomes a hell of a lot more trickier than it would in a husband and wife situation where you can go down, the various ways of separation agreements and court orders and the like. Both, though, however, are very expensive.
Yeah. So while marriage breakdowns and splitting of SMSF and splitting an SMSF and splitting assets in general, everyone, it's a fairly common thing that happens. That doesn't mean it's not expensive, and it doesn't mean that there aren't a lot of problems that crop up. It's just that with these other types, with siblings and business partners and things, it becomes a whole other set of problems. And I guess one of the things which often comes up on this show is documentation. So my understanding based on the article and some other looking around is basically, if it's in the deed, you can have rules in the deed that make this a bit easier, but it has to be done in the deed, basically.
Correct. And equally, and I think this is something that we're getting better as an industry, but we look to the deed. But if we have a corporate trustee, we're not only needing to consider the deed, but we've got to consider the company. So the constitution that governs that. And quite often I come across scenarios myself where there's an inconsistency because we might have had upgrades to the deed, but the requirements of the constitution are very different. And therefore the actions that you thought might have been happening in the deed are irrelevant because of the corporate trustee structure. So we're looking at shareholders and directors as opposed to individual trustees. So making sure the house is always in order and up to date. And you're starting at an outcomes basis and managing, all the risks for your clients. And then where relevant, you might need to tailor certain parts of the documentation. And I use that term quite broadly to ensure that you manage the risks of those relationships that might exist within the fund above and beyond a normal husband and wife or partnered situation. Because when these things blow up, they usually blow up pretty hard and it gets very, very ugly.
I guess that is the other thing, isn't it? That when you're dealing with this, you're not dealing with people that are perhaps always thinking clearly. They might be a bit angry about some things, and it makes the whole thing a lot tougher.
Yeah. And in a lot of instances, you've got to highlight these issues up front. So, whilst everything is all happy and, everyone's smelling roses, at some point, if things go bad, well, you need mechanisms that may then look to deal with those like you do in any other type of relationship that will exist in business and life generally.
Absolutely. And so another piece that we're just going to talk about is to do with pension drawdown requirements within SMSFs, and just that some of the rules around this have changed recently, and basically some funds are finding that they don't have the cash flow within the SMSF to meet these pension requirements, and the possibility that they may need to sell off some assets to kind of cover these costs.
Yeah. And a lot of this goes back, we can kind of correlate this back to the objective of super, which I know we've spoken about a little bit in recent times as well, but we've now seen from the 1st of July, the temporary reduced minimums go back to their normal figures. And that does mean that for many SMSF members, they're going to have to draw down more than what they've done over the past few years through that pandemic period. And throughout that time, many of those clients have got older. So they've not only moved 50% in the number, but if a person has gone from 63 years of age to 66 years of age, they've gone from 2% up to potentially 5%. Okay, because they've had a change in the minimum pension factor or percentage that needs to be applied as well. So that does put some greater pressure on the fund having enough cash flow to be able to meet the pension payments as and when they're due. And the reality then may be that they need to sell down assets to be able to deal with that. During COVID, then that was the recognition of the government. They didn't want to have to sell. People have to sell during periods where asset values have been depressed and so forth, but that's not necessarily the case now. And again, I go back to that objective of super comment. The objective is that you are to be drawing benefits down in retirement. It's not there for bequests and other things. So the government's expectation is that in a perfect world, you will use up that capital base over your lifetime, and then potentially for the beneficiary spouse or something, and kind of the bequests won't really exist. We know that doesn't happen in a perfect world, but that's the concept. And I think people are more conscious these days of, living off the cash that the fund generates rather than necessarily worrying about, well, I've got to actually now make some decisions to sell down some assets. And where we have quite significant asset concentration, it becomes much more difficult to deal with that. I use the analogy, you can't sell a brick at a time. If you've got a property, you would need to actually crystallize that entire property. And I think the other comment that was made by Linda in that was that, the other way in which you could deal with this is by transferring assets out in specie. But the reality has been since 2017 is that commutation of a pension, and then where you take that lump sum, it is a lump sum, so it doesn't count towards that minimum pension obligation for the year. So even if you go, well, I don't want to liquidate assets, I just want to move them into my name, that's not going to overcome that minimum pension obligation for the year.
Yeah, it becomes a separate category. It's not counted towards the pension requirements.
Yep, absolutely.
Yeah. And so there was also a few things in there that, a couple of comments where, if they're clients under 75, they still have other taxable income that they may want to contribute the excess pension payments back to the super and then claim a tax deduction. And so I guess that's one of the things that the advisors need to be looking at, these different methods to do in a way that their clients get the best outcome, I suppose.
Yeah. And so what these changes have meant with the expansion of the contribution rules for someone to age 75 is that we have a decade in essence now whereby the contribution rules are overlaid with the pension rules. So historically, unless you'd met a work test, once you'd got to 65, you needed a work test to be able to make contributions. So if people had retired at 65, that was the ability where you had access to superannuation benefits, but then the ability to do contributions, that tap turned off. Now that expanded to 67 and it's now 75, but it means that we have this interplay where we can take advantage of taking benefits out, pension payments, lump sums and whatever, but get the money back in. And that can be done to help meet that minimum pension obligation. So it could be that we don't have enough cash. We pay out a benefit, we tip it back in and we kind of pay it out again. But any time that we're putting money back in, we're potentially, or not potentially, we're creating an accumulation interest again, and we may need to turn pensions on with that. And then that has a pro rata minimum obligation as well. So there's a lot of strategy in there for advisors to really sink their teeth into. And that is part of the opportunity for SMSF advisors to understand the nuances of the tax and the superannuation laws and, how the deed will apply for the payment of pensions and the like as well.
Yeah. And I guess it's good to take these on a case by case basis and understanding the individual circumstances, of course. But on the face of it, that method certainly would seem beneficial over, say, selling a house that's owned in the SMSF, just as a general kind of look at things. But
yeah, so again, it's part of your investment strategy. You have to consider, your liquidity and your ability to meet obligations as and when they fall due. And so there are some clever ways that you could be looking to achieve that outcome. And I know many of the specialists in this space certainly, look to the laws, drill down in them, understand them and apply them to their full effect.
Yes, that's why it's a good idea to have an advisor sometimes.
Yeah.
Preaching to the choir with this podcast, but still.
Yes, correct.
Something else that's kind of come out recently is, the experience pathway for advisors is not something that is new kind of thing where it's been kicking around for a little while, but a lot of the submissions that have been made to the consultation on the experience pathway have been released. One such that came out was the one from the Australian Small Business and Family Enterprise Ombudsman. I know that the SMSF Association has theirs as well. Long story short, a lot of to and fro between the submissions about whether they think it should be kept, whether they think it should be changed a little bit. The general idea with the experience pathway for people that maybe have not been completely across it is the financial advisors have 10 years of experience actually doing advice. And over the last 15 years or something in that range, they are able to get past some of the obligations to have degrees, basically. And that allows the advisor to use their experience as kind of recognized prior learning, I guess, and that they can continue to practice and they don't have to exit the industry. One of the points that a lot of the submissions have made is wanting to add in a sunset clause so that the experience, kind of the 10-year experience, it expires at some point. What are your thoughts just generally overall on the experience pathway? Yeah,
if we remember why this has come in, because we've seen, a fairly large exodus from the industry, and we know the impact that has had on the price of obtaining advice and the fact that advisors just are kind of inundated with the amount of work and red tape and so forth. So one of the ways in which the government thought they could strike a better balance was to obviously give some recognition of the prior experience of those within the industry. So I guess what we're seeing now in these submissions that are being made is, as you said, a variety of responses. So if we think of this one here, I mean, the submission has expressed some concerns, and obviously the fact that they're providing an opt-out of maybe those that are at a higher standard potentially may dilute the quality of advice. But, on the other side of the foot, you'll have the various other bodies, including, the Financial Advisors Association and so forth, that actively, sort of sort this stuff out, because that's what a lot of their members were crying out for. And the reality is, if we didn't come up with something like this, we would end up in a situation where that hole is just going to get larger and larger and larger of the experienced advisors and those that have been in for a long time just simply washing their hands and walking away.
That's exactly it. And so obviously the government is looking at the situation saying, we probably don't want more advisors leaving. There's already been a lot that have left. We don't really want more going. There's advisors looking at it who have done their degrees since all of the frameworks came in, and they're looking at it as, well, God, that was a waste. Why did I do the degree? There's some that are looking at it as, I'm glad I did the degree anyway. I can use that as a selling point to my clients. There's others saying, experience is the be all end all. It's the most important thing. And I guess it's just all these competing kind of perspectives on this idea, and just trying to make sure that advisors stay in the industry, I guess.
Yeah. And that's exactly right. And I know, there's been a lot of discussion for a long time about recognition of the specializations, and that's something that the SMSF Association has been sort of banging their drum for a long period of time as well. So yeah, I think, it's a good opportunity for the government to obviously go and listen to these views, and like all things, they'll take some stuff on board and they'll sort of park the other to the side. And most importantly, we progress forward and give certainty for a lot of those that have been waiting for some period of time now to get some resolution on this.
That's it. It's all about kind of getting that final kind of judgment and understanding where everyone sits.
Yep, 100%.
All right. Well, we're going to take a quick break now. On the other side of the break, we'll have an interview with Simon Aboud from Allianz Retire Plus. He's going to be talking all about retirement income solutions. All right, welcome back. We've now got Simon Aboud, who's the Chief Product and Marketing Officer at Allianz Retire Plus, who's joining us to talk all about retirement income solutions. How are you, Simon?
Going very well, thank you.
All right, great to have you here. Before we kind of jump into the main body of the questions, I thought it'd be helpful for anyone who's perhaps not familiar, although many I'm sure are, to give a little bit of a rundown on Allianz Retire Plus and what you guys do.
Yeah, no problem. So Allianz Retire Plus is a specialist retirement income business that exists within a partnership between the Allianz Group and PIMCO. So Allianz Group being one of the largest insurance companies around the world and provides retirement income solutions in a number of markets around the world. And we're the Australian business that's here to provide retirement solutions for Australians.
Yeah, and I guess on that topic, there's been a kind of a new solution launch, essentially. I believe it's called AGILE, the Allianz Guaranteed Income for Life. So being described, been a next generation retirement solution. So I guess what I want to find out from you is what that all means. I know there's stuff about full advice platform integration, can be embedded within the super funds, account-based pensions. What can you tell us about this product?
Yeah, look, we're really pleased to be making available AGILE, or the Allianz Guaranteed Income for Life retirement solution. The origins of this really is when we look at some of the problems that retirees face. One of the big challenges is, how do you secure a certain reliable income stream and have confidence to spend in retirement? So I guess with that challenge in mind, we've created the Allianz Guaranteed Income for Life product, which provides a guaranteed lifetime income, but with the flexibility to access your capital as needed. And I guess one of the things we're seeing is that retirees are living longer, which is great news. But one of the challenges that comes with that is the need to fund retirement over multiple decades. So, for example, if you take a couple who are age 65 today, there's a 50% chance one of them will live well into their 90s. So that's really the opportunity and the challenge that we're focused on with this product. The other element of the product is we know that it needs to be easy to use and simple to access. So a lot of the feedback we had from advisors is around making sure when you're bringing products to market like this that they fit within their ecosystem and they're easy to use. So to that extent, the product's designed so that it can fit inside an account-based pension or inside a superannuation fund as an investment option, and it sits on the administration platforms.
Right. And so you mentioned a good problem to have of people living longer. It's not like anyone looks at that as necessarily a bad thing, but it does introduce that longevity risk of, outliving your pensions, outliving the savings that you've got for your retirement. Can you just expand a little bit on those risks that are facing retirees and advisors.
Sure. So if you think about retirement, it's an exciting time in life. It's a significant milestone that we will all arrive at. But what comes with it is a level of uncertainty around how long you're going to need to fund your lifetime for. So with many retirees, there's an underlying fear or concern about running out of money. So that's an sort of latent risk or concern that many retirees have. But then we start to look at some of the specific financial risks. The first one we look at is longevity risk. So longevity risk simply is the risk that you will outlive your money, which living longer is obviously a good thing, but you want to be able to live a good quality retirement. And during retirement, given it's multi-decade for many people, there's going to be unpredictable markets and personal challenges that come up during that period. The second risk we look at is market risk or sequencing risk. So the risk that, particularly in the early stages of retirement, that there's a material drawdown or fall in equity markets. And that can have quite a profound impact on people's ability to fund their retirement, with many Australians reliant on equities and share exposure. And particularly in those early stages, it means that there's potentially less time for clients to recover. And then the third risk we think about is inflation risk. And so very topical at the moment, people are very aware of that, but effectively the diminishing purchasing power of your funds over time. And what we think about and see is the cumulative effects of all of those risks, and the way that people react to that is really this fear of running out of money. And the very natural response that many people take is to reduce the income that they draw down from their retirement savings in order to protect that capital over the long term. But the consequence of that is that people live a potentially more frugal retirement than they otherwise could. And we see a number of people aging and passing away with much of their superannuation balance intact. So really the challenge for us as an industry is how do we create retirement solutions that are going to give people the confidence to spend in retirement, knowing that they've got that certainty of income and can sort of weather those risks as they arise.
Yeah, and certainly a bit of a tough thing to balance those concerns, because obviously retirees don't want to run out of the money. And, again, if you've got stuff left over, it feels like a bit of a waste. But, I guess from an advisor perspective, the idea behind the solution, AGILE, is I guess that it would enhance the provision of that retirement planning for advisors. I believe, and you can correct me if I'm wrong, but I believe it was developed in like a bit of consultation with the advice community. Can you just give us a little bit of background on that process, what sort of feedback you were hearing from advisors and what you were trying to solve with AGILE in terms of that functionality and integration with advisors?
Yeah, sure. So yes, it was a very iterative process and involved a lot of discussions, both formal research and informal discussions with retirees, advisors, platforms, superannuation funds. And what we found through that process and what we're looking to do is really anchor on what's the core problem that we can solve, or core opportunity that we could create for retirees and for advisors to help their retirees solve. And it really did centre around this: how do we create a solution that gives retirees confidence to spend in retirement, but have that flexibility to access their capital as needed? So that's sort of the anchor point. And then when you start to dig into the other feedback we got from advisors and from retirees, a lot of it's around the nature of the income. So wanting to distinguish between a certain known income, which you get from a guaranteed product, a life company, versus sort of a best endeavours style income. So it was important that in the product design and the feedback that we were clear on what we were delivering in terms of the nature of that income. Flexibility is actually, it's a very big issue, and one we got a lot of feedback on in terms of clients investing in retirement solutions, but acknowledging, because there is that multi-decade period, that their circumstances might change, and how can they access their capital and as their circumstances or unexpected events may arise. So flexibility and access was important. A number of people, while we talk about longevity and people living longer, unfortunately not everyone's going to live longer. Some people do pass away in the early stages of retirement, sadly. What advisors and retirees want to know is, well, if that happens, can my loved ones benefit from the remaining investment value? So really a full death benefit and understanding what happens in those scenarios was important. And then the final one I'd touch on is, with retirees, while they're moving into a different phase of life, they can't completely put the brakes on the growth of their portfolio. And so what they're looking for is solutions that are going to help them continue to have exposure to growth markets, but with a level of protection, so that if there are major drawdowns or major falls in those markets, they don't experience the full fall. So that was really from a retiree perspective. Just briefly from an advisor perspective, we all know that advisors are extremely time poor. So it's important that the products fit within their advice processes. And as I touched on before, that they sit on platform and within existing structures so that they're easy to use and efficient for advisors. So they're all of the insights that we got, and they're all of the challenges and opportunities that we've sought to solve through Agile.
Yeah, I guess anything that can help an advisor kind of speed up their processes, I'm sure they'd be happy with.
Yeah, completely.
So we have seen a lot of, I guess there's a need for innovation, greater innovation with retirement income products. You know, there's been the retirement income covenant, which came into effect last year, I believe. Tell us a bit about this need for innovation and how the retirement income covenant has maybe changed the industry from the perspective of the funds. Yeah, and in terms of innovative thinking, I guess.
Yeah, sure. I think when we talk about innovation, it's important to think about it in the context of the problem you're trying to solve or the opportunity you're trying to create. So when we think about innovation and we think about retirement savings and retirement income, we think about two distinct parts of the market. So we think about the accumulation phase. And what we've seen over the last 30 years is really a massive amount of innovation in the accumulation phase. And Australians have been great beneficiaries of product innovation, tools to help with asset allocation in the accumulation phase. When you think about the retirement income phase, the objective is quite different. So the objective is, how do I source a predictable, reliable source of income so that I can spend with certainty in retirement? So that requires a different set of products and different set of tools. We haven't seen as much innovation in that part of the market over the last 30 years, although we are starting to see that innovation coming to market now with the next generation of retirement products. And what the retirement income covenant really has done is put a spotlight on that retirement income piece and the need for greater innovation in that part of the market, if you like. And that's been supported by a call to action from APRA for life companies, super funds, platforms to really work together and collaborate to deliver solutions that are easy for advisors to use but are effective for retirees in solving their problems. And we're starting to see that innovation coming to market now, and I'm sure that there's a lot more that's to come over the next few years.
Right. And so we've heard, I guess from the advice side, the advisor's point of view, from the consumer's point of view, it does feel like because the super guarantee's been around for so long and people are perhaps thinking about retirement a bit earlier, that newer generations are probably going to be retiring with a lot more knowledge, a lot more guidance, a lot more control even, particularly if you're thinking about the SMSF space, but a lot more control of their retirement income than perhaps the generation before them. What would your take on that kind of idea be?
Yeah. Look, I would agree with that. I think there's a few things there. What we see is, with this large number of people transitioning into retirement, there's a lot more information, not just around financial help and financial information, but actually more holistic information around how do you think about your purpose, your well-being into retirement. So we're seeing that and we're involved in a number of initiatives around that side. But if you focus just in on the financial side, retirement involves very significant decisions and complex decisions. And what we see is that the way that information is being delivered to help retirees is that there's a lot more channels available now. So there's podcasts, there's video, we've got websites, we've got a lot more different channels to get the information available. I think where there's opportunity for us to continue to improve is the quality of the information and making sure that we're getting to retirees information that's relevant, of high quality and timely for their circumstances. And I think we're starting to see that now, and there's certainly a big wave of that coming through, but I think we'll continue to see that improve and evolve over time. The final point I'll probably make on it is retirement is very personal. People retire with different goals, different aspirations for their retirement, and with different circumstances, different resources and the like. So the other challenge around information is, how do we make sure that we're providing the information that reflects the range of different decisions and the range of different goals and aspirations that retirees have? And I think we'll continue to see that evolving over time.
Right. Yeah. Just making sure they're getting the right info is always important.
Correct. Yeah.
So looking from a kind of broader, a more macroeconomic kind of perspective. So what are some of those macroeconomic themes that are affecting retirees and, been a very turbulent period. There's been a lot happening, inflation, higher interest rates, which obviously for retirees, the interest rates might not be that direct impact, but the flow-on effects that come with it. There's all of these kind of challenges and concerns that then retirees bring to that. And, not just retirees, everyone, but retirees in particular, I guess.
Yeah, look, there's no doubt we've been through a fair bit of volatility and different market dynamics over the last number of years. And I think to one of the points you make there, when you look at it through the lens of a retiree, it's a particular perspective. So when people retire, they're making that transition from having typically an employment-based reliable income stream that they're used to effectively becoming self-funded or through their superannuation savings or combination of self-funded and age pension support. So there's already that level of uncertainty that exists with clients. So when you start to get some of these macro market dynamics that are happening, it has a bit of an amplified effect on their confidence and that level of certainty. So if we look at some of the themes specifically, we've seen the end of sort of record long equity market bull runs. And so a large number of investors, as we've touched on, have investments in equities to help fund their retirement. They rely on dividends as a source of income. And what you see when we get this sort of level of volatility is their capital obviously reduces and they start to draw down an income off a reduced capital base. So what happens then is as markets return, their growth is coming off a lower capital base. So that has an impact. And if you sort of think about that from a numbers perspective, a fall in the markets of about 12% would require a 14% increase to return to the same space. So that definitely dents confidence when you get equity market volatility. In terms of inflation, I think it's well documented. We've had high inflation, but which is problematic in terms of the purchasing power of someone's money. But the knock-on effect of that is the response, the monetary response. So in terms of rising interest rates, what that's done for a number of clients who hold fixed income is we've seen fixed income valuations fall. So clients have seen volatility and movements in various parts of their portfolio, which is unhelpful for retirees. But that's why, from our perspective, it's really important that clients build in a foundational guaranteed income into a portfolio, because when you get those periods of market volatility, which you're going to get over an extended period of time, if you're looking to fund a 20, 30-year retirement period, there's going to be volatility and fluctuations in the market. But if you've built in that foundational income that's known, guaranteed to come into your account, it helps buffer you a little bit of that from that and gives you a little bit of confidence. We also think it helps clients stick to their strategies through the long term as they've got that confidence of income coming in. So it may help some clients avoid making short-term reactive decisions during volatile markets and stick to their strategy for a little bit longer, knowing they've got that certainty of a guaranteed income coming into their account each month.
Yeah, I guess I'd not really thought of it, that transition from employed to self-funded. I'd not really considered in that perspective before. And I could totally see how you're looking at the balance and it's reducing and it's just going down. Yeah. And that being a real hit to the confidence, I guess.
That's right. Yeah, that's right. So I think it is that transition, and that's what really feeds the uncertainty, which, as we were talking about earlier, the natural response for many people is to live a more frugal retirement, to help. It's almost self-insurance, if you like, by drawing down less income. And so as an industry, what we can do is help clients with that confidence.
Yeah, absolutely. And so when you're looking at, client suitability, specifically within SMSF members or trustees, I suppose, can you share a bit of how the product works and what the appeal for that segment would be?
Yeah, so this style of product really suits a self-managed super fund because it combines certainty of a guaranteed income, but with flexibility. And let me just sort of talk through some of the aspects of that. So the product's been designed so that it can fit into a superannuation fund, an SMSF, during the accumulation phase. And that really helps people approaching retirement to start to pull the building blocks that you need and you will need as you transition into retirement early. And what we know is about 50% of people will retire at a time not of their choosing, whether that's due to health reasons, becoming a carer, potential redundancy. So it's important to have the flexibility to start to build those blocks early and be ready for retirement. Beyond that, in terms of the specific product features, the product allows clients to continue to have exposure to growth assets in the form of equity indexes, but with protection so that if there are market drawdowns, the client doesn't experience the full market drawdown. So it allows the clients to not have to put the brakes on the portfolio, but continue to have that growth as they approach retirement. And within that, thinking about some of the different options, you can basically skew the product so it has either an Australian equities index exposure or an international index exposure with different levels of protection. So either a partial protection or a total protection option. And what that really does is it puts the client in control and the advisor in control of how this product fits in with other assets within the portfolio. And finally, the client has the option to turn on the income when they're ready. So after the first 3 years of being in the product. So what that does is the client knows that every year exactly what percentage of their account balance will be converted into an income stream. And when they're ready, they can just let us know and convert it into a guaranteed lifetime income stream. And finally, because it does sit as an investment option within the superannuation fund, it's consolidated, it's administratively easy, and it really acts as just another investment option for the client.
Right.
So it's that combination, I think, if you like, it's the best of both worlds. It's the control, but with the certainty.
Yep. And so if we were to look ahead, perhaps over the next 12 months, what do you see the retirement income landscape looking like?
Yeah, well, I think it's a pretty exciting time for the retirement income landscape. So there's a lot of innovation that we've got to bring to market, and we know that others are working on and bringing to market. So I think you're going to continue to see this evolution of the next generation of retirement solutions, and what comes with that is enhanced tools and education and information to support that I guess, rollout of a next generation of retirement products. We're going to continue, I think, to see that. We're aware and we're participating in a number of collaborations with superannuation funds and with platforms. So you're going to start to see those collaborations also come to market. And that's important because, it's one thing to have a product, but it's important that the product then fits within the ecosystem and it delivers an advisor experience and a retiree experience in all aspects. So I think you're going to start to see more of those collaborations coming to market. And I think also we've got this large transfer of wealth from accumulation into retirement. So at the moment, there's about $50 billion a year that are transitioning from accumulation into retirement. That's going to grow to over $200 billion over the next 10 or 15 years. And that's, I think, is going to really underwrite and underpin this continued long-term innovation that we're going to see within the retirement space. So I think it's a pretty exciting time. And I think Australians are going to be much better served in the future in terms of their choices and the products that are available and solutions that are available for them to really secure their retirement and have confidence to spend in retirement.
Right. And certainly sounds like they should expect some innovative things coming, probably from Allianz Retire Plus as well.
Yeah.
Can you give me just a little bit, before we wrap it all up, just a little bit about how I guess Allianz and Retire Plus is going to just respond to these all of this stuff that's happening?
Sure. Well, look, Allianz has been in Australia helping Australians secure their future for over 100 years now. And so we've got a long-term commitment to Australians, and the Retire Plus business is our commitment to helping Australians have a better retirement. As you mentioned, we've got some innovation ourselves that we're going to continue to be rolling out in the shorter term. Really, though, what we see our role as is really listening to advisors, listening to retirees, understanding what challenges and opportunities that they're facing into, and seeing where we can add value, where we can bring solutions to market, use the resources that we have to help create solutions that are going to lead to better outcomes for retirees, help them get that certainty in retirement. And in doing that, we're looking forward to continue to partner with the various stakeholders within the finance industry, so with the platforms, the super funds, the advisors, to come together to really support that rollout of continued solutions for retirees.
Brilliant. Well, thank you for joining us today, Simon. It's been, I'm sure there's a lot that people can pull from this to get a bit of an idea about what's been going on in the retirement income landscape. So yeah, thanks for joining the show.
Thank you for having me.
Not a problem. All right, and we're back now, joined again by Aaron Dunn. We're just going to do a bit of a wrap-up of the week, Aaron.
Yeah, well, I think for me, really interesting, this challenge that'll present for the current financial year with pension requirements, the fact that we've moved up to our normal factors again. We've got different funds with obviously different mixes of assets. So we know that, whilst there might be dividends and interest rates are higher, which are all certainly helping the ongoing cash flow for certain funds, there are other funds that may be dealing with tenants that are struggling and businesses that are as landlords and therefore keeping up to date with payments and the potential catch-up payments and so forth in their own right are going to be creating some fairly significant challenges. So navigating through a lot of these cash flow requirements for the year are going to be absolutely crucial, and therefore making sure that this is right and prospectively looking at these things so you can adequately manage these with your clients, to me, is going to be very interesting, because if you don't meet the minimum, the ATO is very clear. You have failed a pension, and at no stage during the year are you deemed to have a pension. And whilst there are some extenuating circumstances that may allow for that pension to continue, generally speaking, it can be a pretty dramatic outcome. Yes, for account-based pensions, but even more so for transition to retirement.
And I guess it's part of a larger trend of all of the kind of frozen measures that happened throughout the pandemic, that they're all kind of coming to an end. Everything is stopping, and it's getting used to those changes. And when there's been a freeze, the end of it kind of seems more dramatic than had it just been ongoing.
Yeah, absolutely. And I think I said earlier on as well, the reality is that during that period of time, there's a whole heap of people that have moved an age bracket as well. So they're not only gone from a 50% rate where they might have been at 2% or 2.5%. They're now at a 5% rate or a 6% rate, which is actually more than the 50%, because they've not only gone back to their ordinary rate, but they've actually jumped an age band as well, because they're now beyond 65 or 75 or 80 or whatever that relevant payment factor is.
Yeah, it's kind of like the mortgage rate cliff with the fixed rates coming off. It's similar to that, where had it been for everyone who was kind of getting the incremental increases, you kind of get used to it. It's that the idea of if you put a frog in cold water and start boiling it, he won't notice. But if you put a frog into boiling water, he'll jump straight out. It's that kind of thing. Yeah,
absolutely. Well, speaking about frogs, no, I'm joking. We do obviously have our reminder, of course, of our upcoming SMSF Adviser Technical Strategy Days in October.
That's right. We're not going to let anyone get out of this podcast without listening to it. On the 17th of October in Sydney, 18th of October in Brisbane, 25th of October in Melbourne, we have the SMSF Adviser Technical Strategy Day, emceed by Aaron Dunn.
Yep.
Everyone should have heard of him. For anyone in other states, you can, of course, also buy tickets and live stream the events. You don't need to head out to Sydney, Brisbane, or Melbourne, although you are more than welcome to do so. Tickets are on sale for this event, and happy to get into it.
Yeah, absolutely. They are fantastic events to go to. Great lineup of speakers. And the topics, obviously, talking about the things that are most current, live, and potentially emerging at the moment as well. So, cannot recommend it more, and go to the SMSF Adviser site to find out more information. And speaking of finding out more information, if anyone has any suggestions on speakers, topics, and the like, how can they get in contact with us?
They should get to us at editor@smsfadvisoronline.com.au and send through anything they want us to hear about.
Excellent. Well, thank you once again for joining us for this edition of the SMSF Adviser Show. I hope you have a great rest of the week. Take care, and bye for now.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.